For months, Wall Street thought a December interest rate cut was practically guaranteed. The Federal Reserve had already cut twice this year. The official story is that inflation has cooled from its peak, and investors were betting that a third reduction was definitely on its way. But now, what once looked like a sure thing has collapsed into uncertainty. Inside the Fed itself, sharp disagreements are erupting, and officials are openly contradicting each other about whether the biggest danger facing the U.S. economy is stubborn inflation or weakening job growth. Which one is it? Nobody knows, or at least nobody wants to admit. The Fed's 19 policymakers are now split into effectively rival camps, each warning of very different risks, very different dangers. Over this past week, several officials sounded alarm about persistent inflation. They hear growing frustration from businesses and households about rising prices, concerns that, of course, helped drive the affordability backlash that we saw in elections earlier this month. And for them, the danger of cutting interest rates too soon is very clear. It could actually ignite another round of price increases at a moment when millions of Americans are already feeling squeezed by high rents, by high grocery bills, and high insurance premiums. And this would, of course, happen just ahead of the holiday season. But another group inside the Federal Reserve sees something very different. They're watching hiring slow to crawl effectively, and the worry, the so-called low hire, low fire job market, could easily tip into one where layoffs surge. For example, Fed Governor Christopher Waller, one of the most influential voices on the board, just warned that the labor market is near stall speed. He argues that unemployment is the real threat now, not inflation, and that the Federal Reserve should cut interest rates next month to keep the economy from weakening even further. The problem is that nobody has the full picture. The 43-day government shutdown blocked the release of crucial economic data, and it leaves the Federal Reserve partially blind at a time when its decisions are supposed to be, they should be, based on data. They should be data-driven. The most recent jobs report, for example, still dates back to August. September's inflation reading was the last one published before the shutdown, and that's the data they're using now. Policymakers are now arguing based not on fresh numbers, but on partial data, on old data, if you will, and also on some anecdotal conversations with businesses and their own views of the risks. This is not how such decisions should be made, but of course here we are, and this is what we are having to deal with. The Fed is fracturing, in other words. Analysts say the December 9th, December 10th meeting could bring a rare wave of dissenting votes, potentially 4 or 5 if the committee decides to cut, and as many as 3 if it decides not to. And that would be quite extraordinary. Waller joked this week that critics who accuse the Federal Reserve of groupthink should prepare themselves, because this could be the least united Fed meeting in a very long time, in over a decade actually. But the stakes go far beyond internal drama. If the Federal Reserve holds off on a December cut, borrowing costs for homes and cars will remain painfully high. Mortgage rates may have eased slightly in recent months, but they remain far above the levels of just a few years ago. And the housing market is feeling the strain. Housing affordability is becoming more and more painful for many people. According to reports, home builder confidence has actually been stuck in pessimistic territory for 19 straight months. Builders say buyers are very cautious, traffic is very thin, and affordability remains one of the biggest obstacles in the market. Even aggressive price cuts haven't been enough to draw in buyers. Analysts say a true housing rebound may not happen until mid-2026, when they expect mortgage rates to fall more significantly. Of course, that is not guaranteed either. At the same time, the labor market is sending mixed signals. Jobless claims, or the number of people receiving unemployment benefits, jumped sharply between mid-September and mid-October. And it suggests the unemployment rate for October, when the delayed data finally arrives, could be much, much higher. ADP reports that private employers actually shed an average of 2,500 jobs every single week through the start of November. And that is not a collapse, of course, but it is evidence of a job market losing momentum and weakening very, very substantially. Needless to say, the shutdown-related data blackout has only intensified this debate and the issues. Without clarity, there are risks of inflation as well as risks of a slowing job market, really the worst of both worlds. There's another layer to this mess, too. The real stakes are political. High living costs have become one of the defining issues for voters. Even Trump has floated unconventional ideas like a 50-year mortgage that is aimed at reducing monthly payments, an idea that even his base rejected. And in a recent video, I argued that a 50-year mortgage would actually turn a home buyer into a permanent renter. Check out that video if you haven't already. I share some interesting details there. Oh, and by the way, the median age of a first-time home buyer has now reached 40 years old. It used to be late 20s. So the shift captures just how far affordability has actually eroded, and it's continuing to erode. So to sum it up, the Federal Reserve now sits at crossroads. A December rate cut is no longer the default expectation. Markets give it only 50-50 odds, down from 94% just a month ago. And the divide inside the Federal Reserve is widening. It is getting worse, with officials publicly contradicting one another in a way rarely seen before. What happens next will hinge heavily on the data released in the coming days, the long-delayed September jobs report, new producer price data, and whatever the government can salvage from the shutdown-affected statistics. If those numbers show job losses or rising unemployment, the Fed may find the consensus it needs for a cut. If those reports show resilience, rate cut advocates could be marginalized. For now, the only certainty is uncertainty, unfortunately. The Fed is split, it is fractured, the economy is giving very mixed signals, we don't have the most recent data, and the decision that once looked straightforward has become one of the most unpredictable and quite consequential choices that the central bank has to make in the coming weeks. I will keep you posted here on YouTube and of course over on my Telegram, so make sure that you follow me on both platforms for frequent updates. Thank you so much for watching, and if you'd like more content, make sure that you follow me on Substack, Patreon, and on my other platforms. They're linked in the video description below. Take care.